What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Today we got a quick one. We are going to go over stock to flow. Stock to flow is back, guys, with this most recent pump. We have Plan B tweeting about the return of stock to flow. Of course, this is one of these contentious issues in Bitcoin, so I'm going to dig right in there. So we're going to talk about that. And then Bill Ackman came out, I believe it was yesterday, and he said he is going to be or he's closed all of his bond shorts. So that could be signaling that we are, a lot of people are starting to see this reversal in the market that I've been talking about, a climax in rates and all of that. So let's dive right into it. Let me share my screen. Bitcoinandmarkets.com. Check it out. Sign up for the free newsletter, free notifications when I drop content. And this is where you can support me and get perks from being a member. So check out bitcoinandmarkets.com. Okay, let's switch over to a live chart. Bitcoin is still pumping here a little bit. Almost, let's see, it did hit 35,000 today as well as yesterday, just for a brief moment there, sitting right now at 34,705. Let's go down to the hourly, and you can see it did bounce up there. But this is a very nice shape that we are making on the chart. I don't think that we are going into another 10% move. So let's see what this move was here. If I can find the right measurement. So this, from this level that it broke out up to the top, was a 15% move. I don't think we're going to see another 15% move, but let's measure out like a 5% move where that would take us. 5% move would take us up to 36. I've heard other people talking about this 36 level. I'm not expecting this to be a long-term stop or a long-term high or anything like that, but I can see another few days of cooling off in the price. So let's go back to the daily real quick and bring up the RSI, and you can see this RSI, which is the relative strength indicator, and it signals overbought or oversold conditions. And right now we're really maxing up there in the overbought category at 88 on the daily RSI. We haven't been this high since January. And back in January, you can see we had that initial pump on the 13th and 4th or 12th and 13th, got really high on that RSI, kind of consolidated, had one more or two more maybe legs up, but it didn't match the initial strength of the initial move. And we can see that again here in March as well. Big move up, kind of consolidated, another secondary pump, but then nothing really happened. Then in June, big move up, kind of tried to break out here July 14th, 15th, didn't quite make it and sold off again and consolidated. So I can see that kind of happening again. Let me get the path out. And I'll share this next one with Telegram because you guys don't have eyes, but maybe another little push like this and then some consolidation. So that's kind of what I'm thinking at this time, but stay tuned on this channel because I live stream and talk about price all the time. Price is the only thing that matters in Bitcoin, and nothing else happens in Bitcoin if price does not continue to rally. So, okay, that is what's going on there. Let's get into stock to flow. So if you guys are new to Bitcoin, you don't know what stock to flow is. It's stock stands for the outstanding stockpile of some asset. So in gold, that would be the stockpiles of gold above ground in treasuries or in central bank vaults or whatever. And flow is the new production. How much is produced on a going forward basis in certain periods. Usually, sorry, I might move my mic there. Usually it is on a year-to-year basis. Gold is about 1.5% to 2%. Bitcoin right now, I believe it's like 1.7, 1.8%. And at the halving, it's going to go under gold. So that's a big thing. But what Plan B did a few years ago, he took this hard money idea from Safety and some Austrian economics about monetary properties and scarcity. And he created this model that would approximate price or fair market value kind of model for Bitcoin. And it was extremely good for a long time. But then I would say, what was it, late 2021, he was calling for 100K by the end of the year, and it didn't happen. It just started falling. And then we had all the liquidations and all the bad leverage that was getting flushed out of the Bitcoin space that happened in 2022. And he was the butt of a lot of jokes. And a lot of people don't like this theory for many different reasons. Some people don't like technical analysis at all because they think that it's a random walk. Okay. And obviously, I push back on that many times, that chart analysis or technical analysis is a collection, a study of Schelling points on the chart, but also um, humans aren't random. Humans aren't random. And we can say that certain assets are going to perform in a certain way. It's going to be a black swan that makes assets act in a way that it typically wouldn't behave. Okay. All things equal, ceteris paribus, we can say how assets should react in certain situations. Stock to flow is kind of an expansion on that. And I have always thought that it was very, very interesting idea. It will eventually work out to be true. I mean, all of us that have bought Bitcoin do some form of technical analysis. Whether you like to admit it or not, you believe Bitcoin is undervalued. You have done some analysis on the price today versus where you think a fair market value price is in the future. Whether you base that on fundamentals, okay, you can do that on fundamentals, but fundamentals will always have to relate to price. Somewhere, somehow, you are basing this off of relative price from today and into the future. So it is a technical analysis um, in a way. Everybody does it on everything. No one would own Bitcoin if you didn't think it was going higher in the future. And stock to flow says it's going to go higher. So if you are correct and you own Bitcoin now and you think Bitcoin is going to go up, probably dramatically, you will agree with stock to flow. Stock to flow will be correct. It will be proven a good model long term. But anyway, this was not very well received out there in the Bitcoin space. Let's look at some of these responses. I mean, he's obviously has a very big Twitter account. What is his? He has 1.8 million followers, and he's been kind of silent because, like I said, he was chased out a little bit after he made the mistake of picking a price and a time. In this type of work, you never want to pick a price and a time. I've done it in the past, of course. I've done it in the past. Everyone does it, but that's the way to really be wrong. You can be directionally correct, or you can, for the right reasons, or you can be directionally correct by accident. But if you pick a time and a price, you're going to be wrong no matter what. So that was his mistake, and we'll see how this behaves. But if we zoom in here, actually, let's go to his website. This is, what's his website called? Okay, I should have had this pulled up. 1 second. Oh, did I not share that chart? Oh, I did share that chart with Telegram. Sorry, I'm all crazy here. What's it called, man? Well, we'll just go into this look into Bitcoin because it's based off of the same thing. So share this tab. So this is from lookintobitcoin.com. And right now, the model is at 52,000, which, guys, that is not far away. Bitcoin's gone up 15% in a couple days. If Bitcoin goes up another 15%, it's going to be at this model price. It's not that far. And look back in 2012, it was below the model price for a long time. I think that we are going to get to 100,000 before this says we will. Let's see, when does the model say we're going to get to 100,000? September of 2024. I think it's going to be way before that. Way before that. But overall, I don't think it's exactly correct, but the ideas behind sound money and people demanding money that has relative hardness, a high stock to flow, is legitimate. And all he's doing here is making this into a model. So the model will not be 100% correct all the time. That's why back on the tweet, he has these kind of error bands. What is this? These are, what does he call them? I'm looking for the label. Okay, well, it's like a standard deviation, I think. The blue is one standard deviation, and the light blue is two standard deviations. We have never, like back here, I guess in 2017 at the blow off top, we were outside of two standard deviations, all the blow off tops, but none of the bottoms have been outside two standard deviations from the model. And one could claim, and I would be one of those people that would claim that this 2022 and the sell off of the over leveraged situation, with Celsius and Terra Luna and FTX and all the shitcoin leverage and Bitcoin in Terra Luna's treasury and all that, everything getting liquidated was kind of a black swan event that pushed Bitcoin down below where it would have been, obviously. I mean, I've done this before in the past where I take out the weeks where Terra Luna collapsed, Celsius collapsed, and FTX collapsed. You take out those 3 weeks out of 2022, and we would be above this model price of 52,000. I mean, we'd be near all-time highs right now, if not over it. So that is, I think those events kind of put this model into question more than it should have been, but whatever. So that's all I have to say about that. Let's move on to our next story because this is going to be a quick stream. So, I've been talking a lot lately about a climax in markets. Yields were screaming higher. And if you listen to the fear mongers out there, they're going to say, we're going higher. Inflation's going to reaccelerate. Rates are going to 10% on the 10-year. This is a new secular bull market in commodities or whatever, and bear market in bonds. All of these things are not going to happen. Okay. We're stuck in a deflationary grind at the end of a 75-year credit cycle. It's going to take a long time. And the longer we kick the can, the more certain that we can be that the end is not going to be an inflationary blow off. Okay. The end is going to be a deflationary grind, lower and lower and lower. That's exactly what we're seeing. Let's go back to the chart real quick. And I just want to bring up Dr. Copper because Dr. Copper is one of these, he has a PhD in macroeconomics, they say. So we'll go out to the week, or let's go to the monthly chart. And it barely made a new high from the GFC. There were some intricacies with the copper market, like China was buying up a ton of copper and hoarding it during this time. So that gave it more momentum to get over the previous great financial crisis high. It's not the same way. Like if we go to oil here and take it off of log, you can see the blow off top back in 2008 is much higher than the blow off top back in March of 2022. So that didn't reach a new all-time high, but copper barely did, very marginally. But look, it's going down. Okay, how far off of the top was it? The top was set also in March of 2022, and right now it's down 28%. It's down 28% and going lower. And I'll bring that oil chart back up again. Oil is not looking so hot. I mean, it can't even get back to the highs from last year, let alone the highs from the GFC. And the average from 2011 to 2014, the average was $100 a barrel. And we're at 85 today. So 10 years later, we're below the average price. peak cheap oil and higher for longer and secular bull market in commodities is not going to happen, people. So anyway, let's get back to the Bill Ackman piece before we take a look at yields because he had a big call. So Bill Ackman is sorry, I'm going to go to his Wikipedia page. He is an American billionaire hedge fund manager who is the founder and chief executive officer of Pershing Square Capital Management, a hedge fund management company. His investment approach has made him an activist investor. As of June 2023, Ackman's net worth was estimated at 3.5 billion by Forbes. So he's a pretty big, famous hedge fund manager. And here is what we have from Zero Hedge: stocks soar, yields tumble after Ackman says he closed his bond short. Back at the start of August, when the 10-year Treasury was trading just around 4%, Bill Ackman sparked a modest sell-off in rates when, without telling the world something it didn't already know, he tweeted he was shorting 30-year due to, quote, higher levels of long-term inflation, including deglobalization, higher defense costs, the energy transition, growing entitlements, and the greater bargaining power of workers. He did not put in here depopulation or demographics. I actually do have a bone to pick about him using the word inflation. I would say prices are going to go up due to all of these things, but these things are not positive, bullish for money printing, for credit growth. They're actually bearish for credit growth, which is deflation. Okay, but let's see. The bond market could, quote, reprice the long end of the curve in a matter of weeks, and this seems like one of those times. All right. Just under the 3 months later, he predicted repricing has indeed taken place, largely thanks to an out of control fiscal situation, which has seen the U.S. add 600 billion in new debt in the past month. And moments ago, Ackman said he was closing his bond short as, quote, there is too much risk in the world to remain short bonds at the current long-term rates. So he's doing this from a geopolitical sense, not from a financial risk sense, but maybe some financial risk, but he just says risk in the world. Very, very interesting. And furthermore, in a slap to the face of Biden's Department of Goal-Seeking Strong Data, which is then revised much lower 1 month later, the billionaire hedge fund manager said that, quote, the economy is slowing faster than recent data suggests, just in case it wasn't obvious to someone that the U.S. isn't actually growing at 5% pace, as this week's GDP will indicate. The market reaction was instantaneous with 10-year yields after earlier breaching 5% for the first time since 2007, certifying that they now trade as penny stocks and tumbling 10 basis points on Ackman's tweet alone down to 488. And with yields suddenly in free fall, risk and duration are aggressively bid and stocks are surging, reversing most of their earlier losses. All right, well, let's take a look at the charts and see if this has held up. Where are we going? 10-year first. This is one of my main things that I watch. We are back up to 4.94 from that story. They said it went down to 4.8. Let's go down to the daily. Let's see where we're at and bring on some of my lines here. Actually, no, we can hide those. So yeah, it looks like it's surging here today, but it could be a climax here. It could be a climax right at 5%. This is a round number. We could have one more push higher just to seal the deal on this. But overall, we are getting close. The climax is very close. There's a reason why people buy treasuries. When, like Bill Ackman said, when stress is building up and people want to flee to safety, they'll flee to bonds. But there's also another reason, and it's a monetary financial plumbing reason. So there's a thing out there called collateral rehypothecation or collateral reuse, where these money market funds, these banks internationally, they take collateral and they lend it out, or they use it as collateral in a loan. And then the person that receives that collateral, they can then also reuse it. They don't have to go out into the market and buy a 10-year treasury to use it in repo. They just reuse one that they get from their normal business operations. There's been studies on this, most of them quite recently, within the last 10 years from the great financial crisis, and estimates are that the average treasury is repledged 7 times. So in the plumbing of the system, if things start to go wrong financially, there's some financial stress, not just geopolitical stress. What is going to happen? Those people are going to not reuse their collateral as much, because a long string of a collateral chain is more risky. Who owns that? When shit hits the fan, who's going to be left holding an empty bag of collateral that isn't theirs? These collateral chains will unwind. So people are less uh, willing to go out and repledge collateral. They'd rather hold on to that collateral just in case. And so collateral chains shorten. However, that doesn't relieve the need for collateral in the plumbing of the system. So what do these people have to do? They have to go out and buy them. As collateral chains shorten, you shift that demand from rehypothecated versions of treasuries to actual treasuries. So the demand spikes. That's why you see the rates just fall through the floor when there is an actual financial crisis and the plumbing freezes up, because everybody rushes into the primary market to buy, and the price shoots up and the yields crash. So there's lots of reasons why this will happen. Now, I don't expect a crash instantly here. I expect this to top and roll over and head downward. We'll probably have periods of some, bigger candles to the downside. But overall, we should expect a top and a rolling over. And then as things get worse and worse in the plumbing of the system, then we'll see big drops. And the Fed will be forced to cut. They will be forced to follow it down. If they don't follow it down, they are going to be sitting there at 5% for their Fed funds, and the market rate's at 1% for a 10-year treasury. They're going to look like fools, utter fools. And there's going to be no confidence left in the Fed. That's why they follow. They must follow. They try to influence the market, and then they follow. That's what they do. So anyway, Bill Ackman here is confirming some of my thoughts on a Climax in the market, and that's good. That's very good company to have. All right, guys, that's it for this short update. Thanks for joining me, Bitcoin, Ansel Lindner, Bitcoin and Markets. Check out bitcoinandmarkets.com. Check out the Telegram. If you're watching on YouTube or Rumble, like, comment, subscribe. Tell me if you agree with the stock to flow analysis at all there at the beginning. And that's it, guys. Thanks for joining me. See you on the next one. Bye.